we've talked a little bit about this, symbolic rather than substantial?
I think so. You know, the changes are helpful at the margin, and it's a continuation of kind of regulatory changes and structural changes that are happening in China. It's going to help with flows. But as I was saying during the break, I think that the big global investors, they'll just need time to do the research on the names, to get approvals, to put systems in place. So you're not going to have a flood of capital coming within a couple of days. It's a small net positive.
You know, one of our Bloomberg View columnists, Ben Emons from Intellectuals Partners, he makes this interesting point that the correlation between the US Treasury 10-year and Chinese 10-year is at a 5-year high. Yeah. If that correlation continues, do you see an impact on global rates on what the UST does as a result of the pickup in Chinese bonds? Sure.
You know, and what that really is speaking to, I think, is that risk premiums are moving, particularly after the conversations last week with central banks, that you get a correlation globally independent of inflation and growth, which is driven by kind of risk premiums and the marginal flow, the marginal capital flow. If it can get into a market, it'll be somewhat priced off the big global market, which is treasuries. So
that's the thing, isn't it? Like, do you continue to have a bond market that doesn't believe the Fed?
Oh no, I think the bond market believes in the Fed. But the influence of these global factors on risk premiums are wider than just the Fed. It's not just the Fed that's having impact. In fact, you could argue for the last 2 years it's been much more about really the ECB and maybe even the Bank of Japan than the Fed. But now that the Fed's clearly on the move and they've got a stated intention to continue to move, global markets are taking notice.
Yeah, you see convergence when it comes to monetary tightening? No,
actually I think the response to last week's announcements from the ECB in particular are way premature. You know, we've all known that the ECB would have to do something about their policy stance over the next 12 months because they're running out of bonds to buy. They've taken an opportunity when growth's been strong to tell a story, to start that kind of normalisation process. But I don't think there's any hurry there. In fact, our view would be that growth and inflation in Europe will continue to be very low and the ECB will have to keep very easy monetary policy. And it may be less easy than it has been, but it'll continue to be very easy, whereas the Fed's going to be moving to neutral.